What's up, everybody? Thank you for joining me again. I've been wanting to do a video on options writing and how we can detect it in the flow, what the point of it is, and what the benefits of it are. So we'll jump right in here. We did actually I dug through and found some good examples from Friday with timestamps still, so will be good for illustration purposes. But first of all, what is writing? Why do we care about it? So instead of buying to open a contract and paying a debit for a contract, they're selling to open and collecting a credit. So instead of being able to lose only 100% of your position, these writers have a lot more on the table. It requires a lot more margin, a lot more capital. Potentially the loss is infinite. If you were to write calls and the stock was to continue going up, if someone wrote calls on NVIDIA and went to sleep and woke up 3 months later, they could be down thousands of percent. So it's very important to find these guys. They are the smartest money I think we can find. For example, NVIDIA, they began writing in the money puts all the way back in the $100, $200 range, and they've been correct all the way up. Even in the $800, $900 range, they were writing 1,200, 1,100 puts, and split adjusted, it's in the 1,300s now. So some examples from Friday. This is a good single line item on mRNA. Now, can other options flow be writing? Sure, but this is the only way that we can tell with certainty that we can call this writing, right? So this is a yellow transaction. What does that mean again? This line item exceeds the open interest in one transaction. So prior to this, there was only 1,300 in the open interest. That means that yellow means opening new position. They cannot close what isn't there. So if there's not 2,040 contracts there to close, indicates this is being sold to open. How else can we indicate that? Below the bid, right? You buy on the ask, sell on the bid. They swept market order, selling these contracts to open below the bid. This is bearish. This is call writing, some size, short dated. Now, another good example with a multi-line item, these AVGO 1,500 puts they've sold to open or wrote, right? So we have multiple line items here. We have our timestamp still. We can see these are transacting within seconds, 11:48, 57 seconds, 11:49:06. So less than 10 seconds they're getting filled. You do have contract not go down perfectly the first time. It does go down the second time. But again, yellow, exceeding open interest. The prior open interest on this one was 151. They're coming in and writing 1,000 contracts here. So they're selling to open these August 1,500 puts. Bid side, bid side, bid side. Contract price going down is the overall theme here. No change in IV. Now here's one where we get contract price going down, IV going down. So this is a little bit different. These guys were buying these at first and then they came in and started closing them, but this is a great example of what it would look like. So they're buying these above the ask side, price is increasing, and then they're coming in later that afternoon and starting to close them out for whatever reason. But you get the below the bid, IV is going down from 30 to 28, contract price is going down, and spot is actually going up while these contracts are going down, indicating that, like, very certain that these are closing. So you can check open interest on these Monday and see for sure, but a great example of what you want to see as far as contract price, IV, and then timestamp, all the same buyer or seller getting filled here back to back. So hopefully that helps. That's a brief overview, some good examples. As always, if you have any questions, please let me know. Thank you for joining me.